Investor Signals provides a broking account service which incorporates our model portfolios covering the ASX 2050 100, the US S&P 100, as well as the ASX and US High Conviction, which picks up the ideas expressed on the daily blog and in the webinar recordings. We also operate an independent portfolio where we can work in partnership with you to execute specific ideas and utilize derivatives to enhance portfolio returns. If you'd like to know more about the broking account service, please contact me on 1300 614 002. The technology that I'm using tonight is the Investor Signals member area. You can subscribe to it for $1,320 for the year. And if you haven't already taken a free trial, please visit investorsignals.com. Or maybe you've already created a free trial and you would like to reactivate it and have another look at the members area. In that case, just give me a call or drop an email. The table up on screen is something we've looked at previous as we continued to monitor the underlying earnings trend within the S&P 500 companies. And just to recap, so this is the average earnings for the S&P 500 and where the market was at an index level at the last time average earnings were at this level. So where we are at the moment, and I've got a closer zoom up of this, but we're going to have a closer look at these 2020 earnings, and then I'll come back to this table again. So that's the 2020 outlook. So Q2's being completed. We're now obviously only 4 weeks away from Q3, or 5 weeks away from Q3 results being announced. So let's just have a look at sort of what the wash up of Q2 was. That was that earnings fell pretty much in line with the forecast of about 30%. Now what we're now looking for is Q3 earnings, so the September quarter in the US, to have a 20% acceleration, and then into the fourth quarter a 30% acceleration. If we don't get that pickup in earnings, this $30 averaged out over the year comes back to around $120 of earnings. If we go back to the last time we had $120 of earnings, the index was worth 2,000 points, but obviously interest rates were higher at that point. So as interest rates fall, you'd expect the valuation of the market to go up. So what's fair valuation? So let's have a look at some of these example PE ratios. So Salesforce has recently been added into the S&P 100. The S&P 5. The Dow Jones Index trades on 100 times earnings. Netflix 92 times earnings. Adobe 70 times earnings. Facebook 40 times. Amazon 130 times. So these are extraordinarily high PE valuations when you compare to historical averages. And of course, an explanation for this can be mounted, but ultimately the bottom line is that these are stretched valuations, and in past ultimately we've seen some reversion to the mean or a correction in these type of inflated PE ratios. So the graph on screen is the Nasdaq. I continue to suggest that investors watch this closely. The moment the market is above that average, if we see it close below, that's when you want to just start having to think about B-Bus, B-Bos, and some hedging in place in portfolios. And it may be a case of just holding a little more cash than normal, given sort of where the index is at present. Let's move straight into a graph of the XJO, and then we'll. So tonight what I wanted to do is, whereas normally we would roll through the ASX top 100, what I wanted to do tonight is focus on the ASX 50 and spend a little more time on the lists that I manage and have a look at the stocks that have recently been posted on the blog and some recent signals. So up on screen here's the XJO. We continue to be mindful that does this turn into a level of resistance that the market struggles below? Whilst the US grinds higher and stays above that average, there's every chance our market could be dragged back up. But I'm certainly of the view that we must be getting close to a period where that buying demand in the US starts to exhaust, and we do get at least a series of closes below that average. So for the moment, we can see the Australian markets closing below the average. We've got resistance up there at around 6,200 points. The short-term indicators have rolled over and moved a little bit lower, and we're seeing a little bit of deterioration in the banking sectors where they're struggling to hold on to their highs. So with that, we click on the watch list, go in here, we select the ASX 50, get the percentage gains to the top, organize these in buy signals. So as I move through the top 50, we'll get to a point where they switch from buy signals into sell signals. And for those joining us the first time tonight, I'll just give you a quick explanation as we toggle through the charts on what that reference is, what that primary buy signal or what that primary sell signal is. So Sydney Airports is under buy conditions. The rights issue was fully subscribed, and we're starting to see some buying support develop there. Now still there's little visibility on when earnings return to normalized levels, and the prospect of dividends being reinstated is probably really a late 21 story at best, possibly even into 2022. But as we've discussed in previous recordings, we had the $5 level there as support. It's building on top of that, and it's worth just giving it an opportunity to see how far it rallies. But maybe back up to that $6 to $6.50 range would be pretty close to full value given the lack of visibility around earnings. Gold's pulled back slightly, although started to find support on Friday night in the US. So the correction in Newcrest, Gold Roads, Northern Star still of the view that the right trade is to buy the dip in gold. In the case of Newcrest, if we have a closer look at it, support there at around that $30.80. The short-term indicator's starting to turn higher. If we close in a bit more data there, we can see that it's under buy conditions. It's got the short-term momentum arrow pointing higher. The short-term indicator there starting to trend back up. For traders, you could be long this stock with a stop loss below that $30 level. For investors, there's still a place to have gold exposure in portfolios. APA Group, the selling here was a little bit heavier than I'd expected. The announcement with cost overruns in one of their gas line projects. It appears to maybe only have a risk of earnings, maybe less than sort of 10%, so probably something around that vicinity of 5%. But I think given that you're waiting another 5 months for a dividend here, there's a lack of investor demand there. But the story's still in place for APA Group, 4.5% dividend yield. Maybe instead of 5 to 6% earnings growth, that number's relatively flat for 2021. But still look at buying the dip there in APA. Dexus not doing there at the moment. Orica, continue to sort of see this as something that is worth keeping on your watch list. At the moment, the short-term indicators are moving lower. I've got that support in there at around $17, and you may want to just keep an eye on these indicators for them to turn higher at around that $17 support level. Westpac still remain cautious on the banks, but urge you just to save BNKS, which is the Global Banks ETF, in your watch list, and use that as a broad basket exposure to a recovery in the global banks, which is probably unlikely to get underway until a little bit later this year. So I still feel that there's downside pressure on the banking share prices. QBE Insurance, not doing too much there, but up around resistance at around that $10. We can see the short-term sell signals. Ramsay, again, this is a relatively defensive name, even if volatility picks up in the market. So you're getting a 2% yield here. If you sell covered calls over it, you can drive almost 8% cash flow on an annualized basis. It's a slow growth company, but at around this sort of $62. So if you see a break below that 64, I'd take that as an opportunity to enter it from a shorter term trading or even a longer term buy and hold investment approach. Bramble, so we like this given the relatively defensive nature of its income stream, being tied a lot to consumer staples. The stock's trading on a little over a 2% yield, and I think buying this on a dip, so if you see it back around that 1070 level on a soft market, you could think about picking that up between that 1050 and 1070 if you don't already own it. Sonic Healthcare, so this is now trading on a forward yield of around 3%. The market's looking for around 3 to 5% EPS growth into 2021. Again, relatively safe harbour if volatility picks up. The short-term indicators are still turning lower, and we don't have yet that black line crossing back up through the red. We don't have a current algorithm buy condition, and we don't have the green arrow. But as I posted on the blog today, opportunity approaches here. I think you want to keep an eye on this one. I've created a price range there of maybe $32 down to $30, where I'd expect to see it find an increase in buying support and this indicator start to move higher. So add that one to your watch list. CSL, 40 times earnings, 1% dividend yield, 10% earnings growth, still attractive, and for that reason we want to continue to buy this on a dip. So support there is 270. If we see a bit of profit taking in the US and a correction across a few days in the US, I'd expect to see CSL back down retesting that 265 level, and you'd want to look at buying it down there. The ASX, look, as I've mentioned a number of times on these recordings, it's a terrific business, but unlikely to grow revenue or profit over the next 12 months. 2% dividend yield. It is a buy on the dip story, so any sell-off that we have, you want to take a look at this from a trading standpoint, but from the moment it looks to be rolling over, and we'll sort of highlight you on the blog if we see a retest around that $82 level. A2 Milk, there's no dividend on offer here. It is a fast growth company delivering around 30% underlying growth. It trades on an expensive multiple. You can see the wide range that I've drawn there from $14 to $17. Now whether we really probe down further into that range, or sort of this support where we're sitting here at around $17, we can see the build up of the algorithm buy signals. We can see the build up in volume. The short-term indicators, we're looking for these to turn higher. They haven't done that yet, and I'll continue to update you on the blog from a trading standpoint. And the way we're approaching this now is that if we see lower levels, we may look at buying call options in this rather than taking on additional equity exposure there. And if you'd like to know more about how to use derivatives in the market, don't hesitate to give me a call. Fortescue's gone ex-dividend today. Terrific business. Any weakness there, you want to buy on the dip. Centre Group, still a little bit cautious there really around. So now what you've seen happen is we've gone from stocks that are under buy conditions into stocks under sell. So that's a reference to the red box up the top, whereas on the previous charts there you would have noticed the green box at the bottom. So if we look at Fortescue, it switched from sell conditions into buy conditions. At that point it was then added into the model portfolio, and it stays in the model portfolio whilst it remains under buy conditions. So that was the last of the top 50 stocks under buy. Now we're into stocks under sell, where we're the primary signal, meaning the most recent one is the red box up the top. And in the case of Centre Group, we've still got the shorter term momentum indicators there, or the interim trend indicators pointing lower, but the price is a little bit above the short term. But the primary signal is that there's still pressure to the downside there. It's not until the stock sort of ends this downtrend, begins making higher highs and higher lows, that we see that added back into the model portfolio. Vicinity under sell conditions, so we're not doing there at the moment. Our preference is Beach over Oil Search, but I just highlight that Woodside Petroleum's looking cheap at sub $20. and maybe Origin Energy around that 550 looks pretty reasonable as well. Lendlease, short-term indicator pointing higher, but is under primary sell signal there. As I've mentioned again a number of times, we certainly like the long-term story there for Lendlease, but just recognise the difficult trading conditions they face over the 12 month, over the last 6 months, and at least over in the next 12 months as well. Santos under sell conditions, our preference Beach Petroleum and possibly Woodside at sub 20 over Santos. GPT not doing there at the moment. Woodside Petroleum, so at around that $20 level, that's starting to look good value. Stockland's not doing there at the moment, it's under sell conditions. Qantas under sell. Transurban, so it hasn't quite got down to that target of around 12.75. So we'll keep an eye on this, whether it builds support there. We can see the short-term interim indicator there pointing higher. So we'll just keep an eye on that at the moment. But as I've discussed, you're going to see cuts to that dividend over the next 12 months. Mirvac not there at the moment. Horizon getting down to that 425 level that we had as a target, where it starts to get a little bit of yield support, but there's not much in the way of earnings growth there for AZJ, so it's hard to get excited about that. Origin around this 550. I spoke in detail last week about the softer earnings coming from retail electricity side, but the strength in their LNG business. And I think that continues to sort of underpin some of the risks there in slower retail growth for Origin, so around that 550. But we are seeing the company cut their dividend, so it's unlikely to sort of have that dividend support that it had leading into that sort of 550 price range. BHP Rio tracking sideways at this stage. Iron ore's holding up near that 120 to 130 level. Oil prices seem to be fairly stable. Natural gas prices have been strong. So I think in that environment, on balance, even though BHP and Rio are under algorithm sell conditions, they're probably likely to maintain up near those resistance levels, at least until we see a rollover in that US equity market. Ampol, which is the old Caltex business, we see support there at around that $25. I put a post on the blog about it likely to find support around that $25 to $26 range. It is under sell conditions, so we're not looking for it to accelerate too much higher, but just acknowledging that it's likely to find support around $25. Woolworths and Coles continue to hold those and maybe think about selling covered calls. But the underlying businesses are delivering high single-digit growth into FY 21. Rio Tinto, as I mentioned, up against resistance or sell conditions there, but don't see too much downside. So AGL cautious there. We've seen deteriorating profit margins. The FY 20 result was down about 20% on the same time last year, but the stock has corrected a long way from $25 down to $15, so maybe into oversold territory there. But if we're looking to identify something that's oversold, we're probably looking more at Woodside Petroleum, maybe even Telstra at these levels. But AGL, we'll keep an eye on that. Maybe a way to think about AGL is that if you see the price cross back above that average, there may be a short-term trade in there, but clearly the momentum's heading lower, and it's very hard to sort of pick sort of the turnaround in that. Whereas we want to be focusing on those stocks that are under buy conditions at the moment. NAB, assuming that it runs into resistance at around this $18 level, we think given that we're fairly close to some profit taking in the US, maybe the banks are not quite ready to rally. They have another leg lower. South 32 resistance there at around that 230 level. As I've mentioned, profit down about 40%. The commodities that they trade in are relatively soft, and on average down almost 50%. There may be some longer term value there in South 32. a little bit hard to sort of pick the timing given that sort of weakness in that structural trend there. Amcor under sell conditions at $16, but we do see this as a fairly defensive opportunity in the market. 2 to 3% dividend yield, maybe something in the order of 3% EPS growth. So it is a name a little bit like Woolworths or Coles, where you can continue holding onto it and sell covered calls to drive the extra cash flow. Telstra, so we've gone from $7.5 billion profit down to $7 billion profit in FY20, and a guidance range that could be down as low as $6.5 billion over the next 18 months. So that may put at risk the 16-cent dividend. If it did, probably likely only by 2 cents, so you may see that cut to 14 cents. The range there that I've shown is 350 was a resistance, and we can see the sell signal up there. Whether we get down and test this 275 level may be a little bit too low, but probably anywhere sort of where it's sitting at the moment, around that 290 level. Keep an eye on the short-term indicators, and obviously again it's not without its risk given sort of the structural pressure there, but we'll just keep an eye on that, and I'll update you on the blog there. The XFL, which is the top 50 index, a little like the XJO, we're assuming that it's created resistance there and it's rolling over. Macquarie Group up against resistance at around that 130 level. We expect that to roll over and trade lower. Goodman Group, terrific business, just too expensive. So this is a great example of where you want to keep an eye out in the coming months, and maybe over the next 3 to 6 months, where we see a correction in Goodman Group, and you'll see it generate another algorithm buy condition, and we'd be looking to add that back into portfolios, but a little bit expensive where it is there at the moment. ANZ under resistance, lower lows, lower highs. Treasury under algorithm sell conditions, so these are all under sells. We can see CBA under sell conditions there, the most recent signal, the algorithm sell there, fallen from 75 down to 68, still see further downside pressure there. Suncorp, we see pressure there to the downside. Aristocrat, it's hard to sort of build an argument that their earnings really accelerate in this environment, and we may see further, or we may see downgrades to their earnings over the next 6 months. So with the view that around that $29 is resistance there, and maybe some risks to the earnings. Cochlear under sell conditions, and we've been avoiding that. We've been a bit cautious on Cochlear. James Hardie up against resistance there at around that 32. So you can see here in percentage terms, out of the top 50 stocks, probably 80% of them are under sell conditions, which includes Wesfarmers. Now, Wesfarmers, a little like Goodman Group, I think you've got to pause here and recognise that any sell-off that we see in Wesfarmers over the next 3 months is a buying opportunity. You want to own Goodman Group, you want to own Wesfarmers on a pullback. It's giving you exposure to that e-commerce story, which is still the longer term sort of secular growth theme. You're seeing advertising increasing on TV for Catch. So Wesfarmers sort of making that transition into a broader online e-commerce business across Bunnings, Officeworks and Catch, and we think that that's an attractive long-term theme in the Australian market. It's just expensive where it is here at the moment, so just watch and wait for the sell-off and the algorithm buy signal, and you want to be fairly aggressive on that. Computershare, cautious there. I think structural headwinds, so resistance up at $14. Insurance Australia Group, look, other than just it's on our radar, but the buying interest in it's very slim at the moment. The health insurers, we've avoided them. If we go back to the algorithm sell signals, it's creating so that lower low, lower high structure, and it continues to have pressure to the downside. Coles Group, buy this on the dip, so it's under sell conditions at the moment, but we'd expect this sell-off to soon generate an algorithm buy condition. Keep an eye on these short-term indicators. They're getting down to oversold signals. I'd imagine we're not too far away from a buy signal being generated here, and I'll draw your attention to that on the blog. So there's a few names there: Coles, Wesfarmers, Goodman Group, that if you don't hold them or you've recently taken profit on them, they want to be moving back onto your radar as future opportunities to add into the portfolio. And there we are, back to Sydney. So as I mentioned, I'm not covering the top 100 tonight. So what I want to do is spend a time on a couple of other lists that I manage and just help to identify those opportunities that we want to focus on. So what I've done now is gone into my watch list, gone down to my custom list. This is where I type in the stocks on the ASX that I'm interested. List 2 is the US stocks. So we're going to move through these fairly quickly and just recap some opportunities here. So I get the percentage gains to the top, organise them in buy signal. TPG continue to like this just because I think that the telecommunication space remains reasonably defensive even if volatility picks up. But around that 850 is close to full value, so I continue to monitor that. If we get an opportunity to buy back into it sub $8, I'll draw your attention to it on the blog. Bega delivered their FY20 results last week. Really, the market was pleased with the free cash flow numbers, which helped the company to pay down debt. In forward earnings, growth's been upgraded maybe to somewhere between that 5 to 10% at best, but had been coming from a fairly flat profit environment over the last 12 months. It does trade on a fairly high PE and a 2% dividend yield, but again, as their product range broadens, it appears to be a fairly safe haven if volatility picks up in the market. So it's another one that if you don't own it, buying it on a dip, and I'll continue to draw your attention to it on the blog. But at the moment we can see it's created the higher high, it's under algorithm buy conditions, and the price is above the short-term moving average there, and the momentum indicators continue to move a little bit higher, but I'd be surprised to see it really support much more above 550. I don't know that it justifies compressing too much below a 2% dividend yield where it stands at the moment. GDX is exposure to gold. My preference is Newcrest and Gold Roads over GDX, but all these are obviously going to trade very similar if gold continues to push higher, and a risk-off period in the US equity market could accelerate gold further from this current sort of dip that we're going through. Newcrest, as I've discussed, so support there at around that $30 level. APA Group, hopefully we're getting down to levels there around that $10.50 that it starts to find support. We see that move higher. Gold Road Resources, looking for that to find support around that 150 level. The short-term indicator's just starting to turn higher, and it is under algorithm buy conditions now. This Cure ETF, again, I think it's worth just pausing and adding that one to your watch list. I've created a fairly wide band there between sort of say $54 and $57 thereabouts, but it's getting very close to where I think it's going to find support. If we look at these short-term indicators, maybe tomorrow or over the next couple of days we'll see that black line cross back above the red, and I think that starts to tie in with where that Cure ETF finds support there and an increase in buying interest. BBOS, we're just seeing this pick up, so if you're joining us for the first time, this is an inverse ETF. It goes up in value if the market goes down. The XJOs ran into sort of clear resistance, whereas the US equity market's continuing to grind higher. But BBOS is a way of profiting from volatility picking up. So just as a reminder, if you see that NASDAQ roll over and trade below the average, then start thinking about BBOS and BBUS. Orica, so around that $17 on a dip, you want to look at that. The Vanguard Global Infrastructure ETF, it's a slow mover but likely to find support down here, and a good long-term value there for a broad exposure to global infrastructure. The Global Dividend Fund, keep an eye on this. Any sort of pullback back below $15, I'll draw your attention to it on the blog. Ramsay we covered, so a pullback around that $62 level. Brambles, somewhere around that $10.50, $10.70. BBUS, look, I'll just jump back to that. So as the S&P's continued to grind higher, the BBUS has moved a little bit lower. Just keep, depending on how you want to look at this, if you see this trade above the moving average and these indicators start to move higher, you can start thinking about buying the BBUS. Again, it goes up in value if the US market goes lower, but the catalyst there really is to keep an eye on the NASDAQ and wait for it to break below that average. Global healthcare, again, slow moving, but have a think about this. Maybe it looks to be testing that $99 or $100 support. The next range is down to 95. The indicators at the moment are still trending lower, so you may have a few days of selling before the buy conditions set up there. CSL we covered. Pro Medicus delivered a good result. The stock is very expensive, but a terrific technology company within the medical space, and specifically within medical imaging. It's created sort of this rally from 22 up to 27 following the earnings result. We're seeing a little bit of profit taking. It'll be interesting just to see if we find support at around this 25 level and it can continue to move a little bit higher. But the long-term thematic there seems to still be attractive. Now the Aussie dollar, the US dollar's sold off, so the Aussie's moved higher. But again, if we get into a risk-off period where that Nasdaq closes below that average, you'd expect the US dollar to rally and the Aussie come off, in which case, yanks a way of profiting from that. The ASX, we covered that one. Technology One looks to be back down and testing that $8 support level there, so I'll update you on the blog, my thoughts on that. Alumina looks like it wants to go down and retest that 150 level. DGO, again, preference is Gold Roads and Newcrest within, but DGO's rallied from 270 up to that 350 level there. And A2 Milk, we were looking at that as a reversal of these indicators. And there we are, back to TPG. So I'll just finish tonight just with a quick look at a couple of US stocks. So here's my list on the US side. I'll get the percentage gains to the top, switch them to buy conditions. Raytheon Technologies, we continue to like that, but are mindful that they have exposure to commercial aviation, which is a tough segment at the moment, but at the same time they're one of the larger military defense companies in the US, so part of the business there is quite stable, but to see value there at around that $60 level. Advanced Micro Devices, so this is a chip maker that competes against Intel. The algorithm buy signals have done a very good job of picking up these lows, or the higher low formation, but this is trading on 170 times multiple now, so it's an example of where things are starting to look a little bit expensive. Fox, not really doing too much there at the moment. This is a interesting one. This is a biotech company in the US. At $100, it found support there. It's crossed back above the short-term indicators. The short-term momentum indicators certainly moving higher, and forecast earnings growth varies from 10 to 20% among most analysts here. From a technical standpoint, the setup is starting to look pretty strong there. So this was one that I'd posted on the blog a week or so back, and we've now built positions in that, and we'll stay long as it stays above that $100 support level there. Again, just drawing your attention to recent algorithm buy signals here in the US market, and you can go back in and toggle through the ASX 100. So to do that, you'd come in here, go down to the US, and you could toggle through those to have a closer look at them. I'll just draw your attention to these. So Berkshire Hathaway's done very well, and you saw in the news where obviously he's increased his stake in Bank of America, started to build exposure among the Japanese trading houses over the past 6 months or so, and Berkshire also gives you a fairly broad exposure to the technology themes, given they're one of the largest shareholders in Apple and some of the other leading US tech stocks. But we'll continue to keep an eye on sort of where this is. It would appear that maybe up at around that 230 starts to run into a bit of resistance there. Analog Devices, so again, chip maker or technology company in the US there, algorithm buy signal around that 110, starting to push higher. Johnson & Johnson has performed well, so support there around that 130 level, now pushing 155, so owning that and selling covered calls. Wells Fargo is an example of where the US banks are under pressure, a little like the Aussie ones. We can see Wells Fargo's gone from $60 down to 25. If we have a look at Citigroup as well, it's in a, which might be a little bit further along. But VeriSign under buy signals there, not doing too much in that name at the moment. Another biotech stock there, so under algorithm buy conditions. And if you have an interest in US stocks and you'd like to set up a portfolio to have exposure to some of these themes, then again, just give me a call. Verizon Communications, we see that up near full value there at the moment. Buy signals there at around $93. Netflix, so it was last under buy conditions there at around that 270 up at 520. We think that's too expensive at 90 times earnings. Eli Lilly now under buy conditions there at around that 150. So in Citigroup, so this is one that's just worth pausing, and so think about this in the similar context to say CBA and its importance to the local banking market. Citigroup, obviously a global leader within the banking sector. So we're watching to see whether this $55 level actually develops as resistance for Citigroup or whether it can start building on that. One of the things to keep an eye on is the yield on the 10-year treasuries, just to see if the yields start creeping back up, then that's going to be fairly bullish for banks. But at the moment, I think the greater risk is still increase in bad loan provisioning, surprising further into coming quarters. American Express under sell conditions up there at around that 100 to 110 level. Hard to sort of gauge what the downside risks are here, but generally we're sort of fairly comfortable with American Express on a longer term perspective. Salesforce just recently been added into the Dow Jones, so just keeping an eye on how that behaves, and then back to Raytheon. So if you're access to the members area, what you want to try to do is come in, have a look at the blog post that stores the last 30 days of blog posts. ASX Signals stores the last 7 days, and you want to toggle through those and help to identify some of those opportunities, and ensure that you're reading the blog each morning at 11 o'clock and attending the future Monday night webinars. Thank you for listening in.